The government is panicking. I'm your host, Steve Van Meter, and thanks for joining me today. In our lead story today, Treasury Secretary Janet Yellen called for an emergency closed-door meeting on Friday with some of the government's top officials in the banking and finance industry. And this meeting comes at a time when outflows from small and mid-sized banks continue to threaten the insolvency of more banks. We're going to take a look at why she called for this meeting and what the real purpose was behind it. You'll be shocked to find out the truth. And we're now hearing from Bank of America's top equity analyst who's saying it's time to get out of stocks. We're going to put this to the test to see if he's right or wrong. Plus, we're going to take a look to see how the economy is interpreting and weathering the storm of the banking crisis. Well, with that, you might just be surprised. Let's head over to CNBC, where we picked today's story up with a headline. Nearly $100 billion in deposits pulled from banks. Officials call system, though, sound and resilient. And of course, when you see money flowing out of a system, the two words that you would not use to describe it would be sound or resilient, because there's either something depositors know that the regulators don't, or vice versa, but clearly depositors now are afraid. The readout really shortly after the market closed on Friday came around the same time as new Fed data showed that bank customers collectively pulled $98.4 billion from accounts for the week ending March 15th. That would have covered the period when sudden failures of Silicon Valley and Signature banks rocked the industry, and data showed the bulk of the money came from small banks, which we've said and covered on this show, as large institutions saw deposits increase by $67 billion, while smaller banks saw outflows of a whopping $120 billion. Now remember, and I want you to keep this in mind as we think about where we are in this crisis. If we are in the beginning of this, then these outflows are going to accelerate. Now it is likely we will see periods of calmness in between next time we see some sort of panic. But for the moment, we actually expect to see these outflows start to moderate a little bit. But if you can only imagine how bad they are now, wait till you see the depths of the next recession. These outflows are going to leave a lot of banks in big trouble, or in fact, may even force them to close their doors altogether. But where is this money going? Well, as we've suggested, it's heading over to the government money market funds. Here we see overnight reverse repurchase agreements. These are deposits or money market accounts held at the Fed overnight. This went from 2.1 to 2.2 trillion here just this past week. The withdrawals brought total deposits down to just over 17.5 trillion and were represented about 0.6 of the total, so still a actual small amount relative to the total amount of deposits. They've been on a steady decline over the past year or so, falling 582.4 billion since February of last year. And as I just mentioned, money market mutual funds have seen assets rise over the past 2 weeks, up a whopping 203 billion to a total of 3.27 trillion, some of that split between the Feds and typical money market accounts. And again, this is where we see depositors moving to. They lack confidence in the banking system, and so they're looking at alternatives, not knowing that a lot of traditional money markets actually are holding bonds and notes from the banks in terms of short-term manner, but other ones are held by the Fed. And this is why we just saw in the data from this past week, Treasury auctions at the 4-week bill should be no surprise. There were bids at 0%. Now, of course, the rate was much higher, but the fact that we're seeing bids at 0% tell us there is a demand for collateral in the system. And obviously, as money flows into money markets, well, they've got to back it with something. And at this point, zero seems to be a better option, because when you have too much money coming in, the simple way to get rid of it is to lower your rates, which we can now expect to see money market rates start to head lower. But banks have been flocking to emergency lending facilities set up after the failures of Silicon Valley and Signature banks. Data released on Thursday showed that institutions took a daily average of $116.1 billion of loans from the central bank's discount window, the highest since the financial crisis, and taken out a whopping $53.7 billion from the Bank Term Funding Program. So here we go into this meeting on Friday, and what I want you to see is deposits are still flowing out. Banks are going to all of these emergency credit lines set up by the Fed and other institutions, and they're doing it at numbers that blow out the global financial crisis. So now all of a sudden on Friday, which is interesting that you would expect to see this perhaps on a different day, which might suggest that, hey, is something coming over the weekend that the regulators are aware of and they want to get ahead of it? Well, no, that had nothing to do with any of that. But anyways, Yellen holds this meeting, and now let's talk about the real reason they're doing this. As Yellen, U.S. regulators say some banks under stress, but financial system, wait a second, is sound. And now this part here from Zero Hedge, I want you to see who showed up at this meeting. If it was a teleconference, we have Janet Yellen, Treasury Secretary, Jerome Powell, head of the Fed. We have the Consumer Financial Protection Bureau, the head of the Securities and Exchange Commission, the head of the Federal Deposit Insurance Corporation, the head of the Commodity Futures Trading Commission, the head of the Federal Housing Finance Agency, the head of the National Credit Union Administration. You have some of the biggest names at the top of banking and finance inside the government agencies showing up at this meeting, which would suggest to you that either they know something is wrong or perhaps there's a whole nother agenda here. And if you guessed, you're right, there is a whole nother agenda. The council discussed current conditions in the banking sector, which notably should be pretty obvious if you picked up any form of newspaper in the last week or two, that while some institutions have come under stress, the U.S. banking system remains sound and resilient in a response after the meeting. The council also discussed ongoing efforts at a member agencies to monitor financial developments. So here you have this emergency closed-door meeting on Friday, and what do they have to say about it? Well, the system is sound and resilient. I'll let you weigh in the comments. Do you believe that that's true? And that they said, we're going to monitor the situation. Well, that's the obvious thing that they're going to do here, is keep an eye on it. But what is the real reason you would bring all of these people together? Is it because you want to admit that you don't know what the problem is? No, of course not. Not one of them at that meeting is going to raise their hand and say, hey, you know what? I have no clue what's going on here. Because nobody wants to stick their neck out, because at some point at this cycle, somebody is going to have to take the blame. So what do you do to mitigate that? Is you bring every power player inside the government together, because you know in the future Congress is going to drag every one of them into hearings to find out who needs to be the scapegoat. You're going to go around and discuss what tools all of you have, who's monitoring what, and then you're going to come to the conclusion that if something happens again, that everybody goes all in with whatever policy tool they have, no matter if it's going to be effective or not. So each and every one of them can say, look, I did my part. And if by some stroke of luck, one of those policy tools work, they can all collectively say, hey, I participated in this and I did my job. And if it doesn't work, which we know it won't work, then not one of them can be singled out, because they were all in it together. This wasn't about reassuring the confidence in the banking system to the people of this country. This was all about covering their own backs. I'll let you decide, which do you believe? Is this to give you a reassurance, or is this to give themselves reassurance? The statement from the FSOC, which has little legal authority. So there's your validation. They have little legal authority, but serves as a coordinating forum, just as I suggested, fell short of what some would have called for, because they have no power. Well, former Treasury Secretary Lawrence Summers had this to say: it's better to err on the side of overdoing it when you're talking about protecting against bank runs than it is to err on the side of underdoing. And so again, this validates kind of what he's suggesting this meeting was about, is, hey, what tools do you all have? Let's put them out on the table, and let's all agree that if something happens again, and we're going to hope and pray it doesn't, but if it does, and it probably will, then we're all going to put these tools to the test and hope that one of them actually works. But someone who is not convinced that any of this is going to work is, well, Bank of America's top analyst. BofA says investor rush to cash is the fastest since the COVID hit, and sure enough, it is. The Fed is likely to cut rates very aggressively over the next 12 months, but that's possible going to start only after the payrolls turn negative. This from Hartnett, and we need to put this to the challenge here because is the Fed going to cut rates? Well, I actually completely agree with that. I'm going to give you some proof here, but do payrolls have anything to do with it? Well, that one, I don't agree with at all. But let's start with the first one. Is the Fed going to cut rates over the next 12 months? And this chart says, you betcha they are. And what we have here is a 10-year, 2-year yield curve shown inverted. So I've got the minus sign over there, and this is the baseline. So you see where this black line is? This is where the curve is normally inverted. So we see these inversions right before recessions as we normally do. And this is run against the federal funds rate in red. And what we can see in every instance is what happens when there's an inversion, the curve starts to steepen. Again, remember, it's shown inverted, so it's going down. This is what's called a bull steepener in yields, and that means the yield curve or the bond market in this case is telling us that the Fed is done with this hiking cycle. They might want to continue. They might say they're going to continue, but the end is actually very soon, and they're going to not just cut rates, but cut rates significantly. Now let's turn to Hartnett's comment about the payrolls, and well, this is where I disagree. He says the payrolls have to go negative before the Fed's going to cut. Well, historically, that's not the case at all. The Fed often is cutting well before payrolls go negative because there's such a look back period. You think about, the payrolls being such a lagging economic indicator that by the time they go negative, it's too late because these things are lagged by about 6 months. But let's continue on to see what else Hartnett had to say. Investors should sell equities, giving the call now to get out after the last rate hike over the negative impact of higher unemployment. It's now a longer than normal bear market, but policy intervention meant stocks have not priced in a large slump, and the biggest bull market recoveries, quote, occur only after the biggest decline. So what he's saying here is stocks need to go down a whole lot more, but is that likely? Well, I disagree with him. The idea that people need to get out after the last hike, well, no, they need to get out after the first cut. And here you can see the federal funds rate in red against the Wilshire 5000 price index. And what we can notice when the Fed pauses and in some cases makes the first cut, you can actually see a rally in equity. So it would tell you that after the Fed pauses, but sometime before or right after the first cut, you should likely see a rally in stocks that will then be followed by a major downturn. So I think Hartnett's got this one a little bit early. But as far as the economy goes, well, the economy says that maybe the bull market in stocks is not over yet. Here we see the U.S. manufacturing and services PMIs coming in hot as inflation resurges. This from Zero Hedge. We have the flash or preliminary PMIs. Here we see the services sector is back in expansion mode at 53.8. I'll call this what I say a slight plus expansion on Twitter. U.S. manufacturing output is pretty much unchanged from the month before at 51, and the overall manufacturing PMI under a very slight contraction at 49.3. But digging deeper into what S&P Global had to say, the upturn is uneven, however being driven largely by the services sector. Although manufacturing eked out a small production gain, this was mainly a reflection of improved supply chains, allowing firms to fulfill backlogs of orders that accumulated during the post-pandemic demand surge. And this is a challenge because backlogs become inflationary, so if they're working through it, it tells us that inflation is indeed coming down. And tellingly, new orders have fallen now for 6 straight months in manufacturing. Unless demand improves, there seems to be little scope for production growth to be sustained at current levels. And since we note that services follows manufacturing, in services there are more encouraging signs with demand blossoming as we enter spring. But how long will that last is a question. But the other good news for the market and for the economy, I'll tell this to Hartnett, is hey, look, initial claims are still low at 191,000. Continuing claims are just under 1.7 million, and total claims dropped a whopping 61,496. from last week down to 1.938 million, which suggests that the economy here is actually in pretty decent shape and so far is shrugging off this banking crisis. The question remains for how long and when the next bank goes, because perhaps that's when we'll start to see a major reaction from the economic data. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.